The imposition of tariffs has a significant impact on international trade, and as these trade policies evolve, so too must the accounting practices that support them. Post-tariff, businesses must adapt their accounting systems to manage the complexities of new import-export regulations, shifting cost structures, and the implications of trade barriers. These changes not only affect the bottom line but also require businesses to enhance their accounting methods, ensuring they remain compliant and competitive in a more challenging global marketplace. In this video, we explore the top 10 changes to international trade accounting post-tariffs and how businesses can adapt. 1. Revised import valuation methods. One of the most significant impacts of new tariffs is how businesses calculate the cost of imports. In a post-tariff world, the cost of imported goods will inevitably rise, and accounting systems must be updated to account for the increased cost of goods sold, COGS. Businesses will need to adopt revised import valuation methods to ensure accurate cost reporting. This includes incorporating the added tariff costs into inventory valuation and adjusting pricing strategies accordingly. 2. Increased complexity in customs documentation. Tariff changes often result in an increase in the volume and complexity of customs documentation. Post-tariff, companies must ensure their accounting departments are well equipped to manage more intricate documentation related to tariffs, duties, and fees. This requires tighter coordination between accounting teams and customs brokers, as well as systems in place to track the relevant paperwork to avoid compliance issues and penalties. 3. Changes in financial reporting for tariff expenses. Accounting for tariff-related expenses will need to be more transparent in financial reports. Post-tariff, companies will likely experience an increase in duty costs, which must be correctly classified in financial statements. Businesses will need to implement new systems to properly track these expenses and allocate them within their cost structures. This may also involve changes in reporting for both internal management purposes and external stakeholders, ensuring full compliance with financial reporting standards. 4. Impact on transfer pricing and intercompany transactions. For multinational corporations, tariffs can have a significant impact on transfer pricing strategies. Post-tariff, businesses will need to reassess their transfer pricing policies to ensure compliance with both local and international tax laws. Tariffs could affect the cost of goods sold in different markets, requiring updates to intercompany pricing arrangements and accounting for these changes in both the financial reporting and tax filings of the corporation. 5. Impact on supply chain accounting. Supply chain accounting will undergo significant changes due to tariffs. The increased costs of raw materials or finished goods due to tariffs will force businesses to reevaluate their supply chain strategies. Businesses may need to shift to alternative suppliers or regions to mitigate tariff costs, and accounting systems will need to reflect these changes in supplier payments, procurement processes, and inventory management. 6. Changes in foreign exchange accounting. Post-tariff policies often result in fluctuations in currency values, which can affect the accounting for international transactions. Companies dealing with foreign suppliers or customers must adjust their foreign exchange accounting methods to accommodate these changes. Currency fluctuations resulting from tariff impositions can impact the timing of payments, the valuation of transactions, and the overall cost of doing business internationally, requiring businesses to monitor exchange rates and adapt their accounting procedures accordingly. 7. Increased scrutiny in auditing processes. As tariffs continue to evolve and affect global trade, auditors will likely place greater emphasis on examining tariff-related transactions. Companies will need to ensure their accounting records are fully compliant with new tariff regulations. Post-tariff audits will focus on confirming that tariff costs are accurately reflected, that proper customs duties are being paid, and that all related expenses are correctly documented. Enhanced audit practices will be necessary to mitigate the risk of non-compliance or financial penalties. 8. Accounting for tariff exemptions and refunds. In some cases, businesses may be eligible for tariff exemptions or refunds, depending on the nature of their imports and trade agreements. Accounting departments will need to track and account for these exemptions, ensuring that they are applied correctly and reflected in financial reports. This may involve additional tracking systems to ensure businesses are not overpaying tariffs and are properly claiming refunds, potentially providing significant cost savings. 9. Strategic shifts in cost allocation. In response to tariff impositions, businesses may need to make strategic shifts in their cost allocation models. Companies may choose to pass increased costs on to customers through higher prices or absorb the costs internally. Accounting systems will need to be adjusted to reflect these shifts, and businesses will have to ensure that they are strategically managing their cost structures to maintain profitability while adhering to new tariffs. 10. Enhanced risk management and forecasting. Post-tariff, businesses must develop more sophisticated risk management and forecasting strategies. Tariff fluctuations introduce a level of unpredictability that requires accountants to implement more advanced forecasting models. Accounting systems must be capable of adjusting to new tariff rates in real time and projecting the potential financial impact on future business operations. This might involve scenario planning, sensitivity analysis, and ongoing monitoring of the political landscape to anticipate future tariff changes. Post-tariff changes to international trade accounting are unavoidable as businesses navigate a shifting trade landscape. As tariffs continue to play a central role in global trade dynamics, accounting departments must adapt to increased complexity in areas like customs documentation, cost allocation, and financial reporting. By leveraging advanced technology and adopting strategic accounting practices, companies can mitigate the impact of tariffs and ensure that they remain compliant and competitive. Adjusting to these changes proactively will allow businesses to safeguard their operations and maintain robust financial health in an increasingly volatile global market.